Hello everyone, welcome back to Econ Pulse. Today, we're diving into the rise and fall of Spain's economy from its booming growth in the late 1990s to the devastating financial crisis of 2008, known as the Great Spanish Recession. What caused this growing economy to collapse, and how did a real estate bubble bring Spain to its knees? Stick around as we break down the key events and lessons from one of Europe's most dramatic financial crises. First, we discuss Spain's economic boom in the late 1990s before economic crisis. Before the financial collapse, Spain was experiencing a period of remarkable economic growth. By the late 1990s, Spain had become one of the most dynamic economies in the European Union. Under the leadership of José María Aznar's first administration, Spain implemented significant liberalization and deregulation reforms that helped reduce the state's role in the marketplace. These reforms, combined with strong consumer confidence and increased private consumption, that helps to push the economy forward. Spain real estate sector. Real estate sector is the backbone of Spanish economy. On that time, property values started to increase, and the country's construction sector helped Spanish overall growth. By 1999, Spain officially joined the Eurozone, which further boosted the economy by lowering interest rates, making borrowing cheaper, and driving international investment to Spain. By 2006, Spain was seen as an economic success story, creating more jobs than rest of the remaining European countries combined, especially in sectors such as construction and services. Unemployment had dropped to 7.6%. Much lower than the 17.5% seen in the 1980s, and Spain was catching up to larger European economies like Germany and France in terms of economic output. Time gradually changes, and we took a look on Spain's housing bubble where the things seem more clarified. From 1996 to 2007, Spain's property sector prices increased by over 200%. The country's economic growth during this period was largely driven by the booming construction sector. Developers were building at a record pace, and banks were eager to provide loans to both homebuyers and property developers. This led to massive speculation in the housing market, with many people buying property not to live in, but to profit from future price increases. Spain's banking system, meanwhile, was taking on excessive risks. The government and regulatory authorities loosened financial regulations, allowing banks to hide losses and continue lending aggressively. The easy access to credit and the speculative nature of the real estate market made Spain's economy dangerously dependent on the construction sector. These all things pushed the Spanish economy into a big hole. Let's discuss Spanish economic crisis. When the housing bubble burst, construction projects gradually standstills. Property prices decreased, and Spain's GDP shrank by 3.7% in 2009. The crash in the construction sector had far-reaching effects on the rest of the economy, particularly in employment. Unemployment skyrocketed. In 2007, unemployment was around 8, but by 2010, it had surged to 17.4%, and by March 2012, unemployment reached an astounding 25, more than double the Eurozone average. Among young people, the situation was even worse, with youth unemployment hitting 50% at its peak. The collapse of the property market also had a devastating impact on Spain's banking sector. Banks were stuck with billions in bad loans tied to the real estate market, leading to a full-blown banking crisis. In 2012, Bankia, Spain's fourth-largest bank, requested a €19 billion bailout, marking the largest bailout in the country's history. This was a clear indicator of the depth of the financial trouble Spain was facing. Now take a look on European sovereign debt crisis. Spain's crisis was not just limited to the collapse of its housing market. By 2010, the country was drawn into the European sovereign debt crisis, which affected multiple European nations. The Spanish government, like others in the region, saw its revenues collapse as the economy comes to recession and tax income from the previously booming housing market disappeared. Meanwhile, Spain's national debt grew rapidly as the government tried to stabilize the economy. At the height of the crisis, Spain was facing rising borrowing costs as international investors lost confidence in the country's ability to manage its financial issues. Although the European Stability Mechanism ESM provided a €100 billion rescue package to help Spain's banking sector, this was not enough to reverse the underlying economic issues. Spain also suffered from a trade deficit and a loss of competitiveness in global markets. The country's heavy reliance on construction and low-value industries not compete whole world markets. When economy drops down, unemployment also increases. High unemployment. Between 2008 and 2012, Spain lost more than 1.2 million jobs. The sharp rise in unemployment left millions of people struggling to make ends meet, and the social fabric of the country began to fray. The situation led to widespread social unrest. In 2012, unions organized a general strike in protest of the government's austerity measures, which were aimed at cutting wages, weakening unions, and reducing worker protections. The government's attempts to balance the budget through harsh spending cuts were deeply unpopular, and many citizens felt abandoned by the political establishment. One of the most striking images of the crisis was the rise in home foreclosures. Thousands of families lost their homes as they were unable to keep up with mortgage payments, which led to further protests and demonstrations against the banking system.